Hey guys, I just wanted to make a little bit of a short video about RSI divergences. I made an article a little while back on RSI divergences, and this is going to be kind of following the same points as I made in the article, and I wanted to kind of put it into video form and show you some real examples. Hopefully it can help you guys get a better understanding of the content. And like I said, as always, just if you have any questions, feel free to reach out. I'm available a lot, and I can just come in, answer your questions if you are unsure about a specific example, if it is valid or not. For example, like, just reach out to me. I can help you out. I can help you truly master this concept of RSI divergences. So let's get started. So in order to understand RSI divergences, we first need to understand RSI. RSI, or the Relative Strength Index, is a momentum oscillator that measures the speed and magnitude of recent price changes to evaluate overbought or oversold conditions in a market. So this is that little line you'll see at the bottom of your trading view thing if you go into indicators and type in Relative Strength Index. And behind the scenes, what this indicator is doing, it is calculating the RSI of a thing using this formula, 100 minus 100 over 1 plus relative strength, where relative strength is the average gain or average loss over a period of bars. So if you go into your RSI and you go into your settings, you can tailor it to whatever you would like. So the standard is 14. So what it'll do, it'll measure the average gain over average loss of the last 14 bars at bar close. And you can change all these settings, but that's basically where the value comes from. So an RSI divergence is where the price and the RSI move in opposite directions, which can signal a potential trend reversal. So there's two types: the bullish divergence, which suggests that selling pressure is weakening and indicates a possible upwards reversal, where so the price is going down, it indicates that we could reverse and start seeing upwards price action. And then on the contrary, we have the bearish divergence, which suggests that buying momentum is fading and the uptrend could be weakening, and we could see a possible potential reversal down in the near future. So the logic behind why this RSI divergence works is that momentum leads price is the idea behind this. And it's essentially a warning that the current trend might be running out of steam. So price might still be making new highs. For the bearish divergence, the price might still be making new highs, but if RSI shows decreasing momentum, it could be showing that the upwards trend is weakening, and we could start seeing a reversal to the downside soon. Let's see. Divergences represent disagreement between price action and momentum, and it often shows like a warning sign before the trend reverses and starts changing directions. So personally, and we're going to go over examples on the chart of this. So, but my rules for RSI divergences are that bullish divergences are only valid when they happen in the bottom half of the RSI, right here below RSI 50. And the bearish divergences are only valid when they occur above the RSI 50. And this is just because when the bearish divergences, if we're trying to look for a short and we see a bearish RSI divergence, such as this one, this is the example I have for it, and it occurs down here, that means there's probably not much more room. If the momentum is already low, there's not much more room for it to go down. So the risk to reward is better when the bearish divergences happen up here, meaning there's a lot of room downwards for it to go, and the bullish divergences happen down here, where there's a lot of room up for it to go. So if you see a bullish divergence and it's up here, I wouldn't call that as a valid bullish divergence. Let's see. They must stay short in length. We'll get to that in the examples. I personally don't count these divergences if they start in extremes, meaning, like, let's say this bottom peak right here was all the way down here at like RSI like 10. I wouldn't count this as a divergence, even if the price is making a lower low and the RSI is making a higher low. That's just because if the RSI is already down here, there's not much lower for it to go. So of course any move is going to be a bullish divergence, and it's not really as clear. You want it to show a more reliable signal, right? And likewise, if the RSI is all the way up here at like 90, like of course the next peak is probably going to be below 90 because the max it can be is 100. So like I said, I want it to be more reliable. So I would like it to show a stronger indicator that it is in fact a divergence and not just, you know, RSI maxing out over and over again. It's just more confluence, I guess. And so those are the rules I follow, and they must stay short in length. So like you can't just go draw a line from here to here when all this stuff happens in between, you know, because you can draw lines wherever you want and fit something to fit what you want to see on the chart. But if you need to make sure that these RSI divergences are clear, concise, and I like to only use RSI divergence that happens on like the low at like two lows right in a row or two highs right in a row, rather than like saying, oh man. For example, this is my example for a bullish divergence, and then so what I mean by short in length is this would be a non-example, an example of what I would not take, even though technically price does make the lower low and RSI does make the higher low from here. But look at all the stuff that's happening in between, right? I would be more interested in a divergence from here to here, or here to here, or here to here, or here to here, or here to here, than like stretching it out and just finding a line that fits your narrative, you know? So with that being said, this leads us to the examples portion of this. So we've already seen these. This is my example of a bullish RSI divergence. So as you can see here, price makes the lower low, RSI makes the higher low. You can see right here. And so that is indicating that this downtrend here, the momentum of the market and the sentiment is shifting positively, shifting to the bullish side. And so it's an indicator that price could reverse and move upwards. And as you see in this case, it did. And so a non-example of a bullish divergence would be, like I said, this one. And this just because it's too far away for this one, right? Another non-example would be, let's say if right now this peak of this RSI was down rather than at 21, let's say it was down at like 6, right? And let's say this was an RSI divergence, right? Or right here. Let's say this was an RSI divergence. This would be the one that I would take, right? Because you can see price still makes the lower low and RSI makes the higher low. But for example, right here, if the RSI instead of being at 27, it was at 6, right? I would not count that as a valid RSI divergence because it's going to be very hard to get the RSI below 6, no matter what happens, no matter where the momentum actually is, right? Because the lowest it can be is 0. There's no such thing as a negative RSI, and there's no such thing as an RSI above 100. It's on a scale from 0 to 100. So for the bearish divergence, I've got right here, as you can see, price makes a higher high, but RSI makes a lower high, right? Here would be an example, a non-example of the RSI divergence on the bearish side, even though price makes the higher high. At the same time, RSI makes a lower high, because look at this. RSI is at 94 here. It's very, very difficult for RSI to be above 94. And as you can see by not counting this, like this short wouldn't have been, like sure we could have shorted it and maybe taken a little bit of profit, but we didn't catch the actual move down. The actual move down is caught with this better RSI divergence, right? This would be a good one as well, right? If you wanted to get into the short, see higher high, lower high. However, this does start above 80, and that's kind of where I put my limit. This would be, I'd be on the fence on if I wanted to count this. RSI is still a little bit too high for comfort to take this one, so this one would be a much, much better offer. As you can see, RSI is at 73, and it goes down to 67. Meanwhile, price makes a higher high. And if we would have taken this RSI divergence rather than this one, which is definite no, and this one would be kind of on the fence, we would have caught this entire move down right here of 54%. This is Bitcoin on the 3-day chart, by the way. We could have caught the end of last bull run with that, right? And then again right here, look at this, RSI. This is a very weak one, but price makes higher high, RSI is maybe making a lower high, maybe it's even. So that would be the example for the bearish divergence, and here's a non-example, right? So this non-example is invalid for two reasons. One, look at this, RSI is at 92. It's very hard to go above that. It doesn't happen very often, so no matter what price does, this 92 is kind of an outlier here, so I wouldn't count this as a divergence. And then also look at the distance here. Look at all of these little peaks and troughs that are in between this line that I've drawn, and it just circles back to, yes, sure, technically price made a higher high and RSI made a lower high, but you can zoom out as much as you want. You could always draw a line to fit your narrative. I would rather wait for a more clear indicator, right? Like something that looks a little nicer, right? Let's see here if we can find one. That would have been a better, not for here. But like I said, look for something more like this, where it's just right there. It's simple, it's easy, it's right in front of your face, and it makes a lot of sense. Like anybody reading the chart could it's a no-brainer. Yes, right? And so going back to my other rule of below and above the 50 line, let's say this RSI divergence right here, the price made a higher high, RSI made a lower high, but let's say that happened right here. RSI started here and it went down to here. That would make this divergence invalid for me, just simply because there's not as much room to go down, right? So the downside might not be as big as if the RSI divergence is up here. So that's why the bearish divergence is only valid if it happens above RSI 50, and the bullish divergence is only valid if it happens below RSI 50 down here. So if this bullish divergence, let's say the RSI started here and went here, I wouldn't count that as a valid RSI divergence. It has to happen below the 50 line. And the lower the better, like the closer to this 30 line, the better. The closer to this 70 line that it happens, the better. If it's extremely high or extremely low, I don't count it, just because, you know, it's the extremes, and it's kind of an outlier, and it's hard to get a clear picture if it is not an RSI divergence, if that makes any sense. So like I said, thank you guys for watching, and like I said, if you guys have any questions relating to this topic, I'm so happy to answer them for you. If you have any examples where you aren't sure if something qualifies as an RSI divergence, or you're having a little bit of trouble grasping something from the video, no worries. Just ask me a question. I'm more than happy to answer and help you guys out. That's what I'm here for. And let me know what you guys think about this format. I'm thinking of replacing my weekly streams that I have a topic going on every Friday with these videos, just because it would be easier for you guys to watch it on your own time when you like, because my schedule is something that it doesn't work for everybody, right? And I want everybody to be able to access this content. So turning them into short videos instead would help, I think, with that. So let me know what you guys think about this format. Let me know if you guys have any questions, and thank you for watching. I'll see you in the next one.